How to protect your assets from IRS tax debt collection. When it comes to debt collection, the IRS is an 800-pound gorilla with a big appetite. If you don't pay your taxes, the IRS gets very disappointed, and will start adding interest and penalties to the menu, with your name on it. If you still don't pay, the IRS gets really hungry. The IRS may take your assets and property, including wages, retirement accounts, Social Security income, bank accounts, cryptocurrency, cars, boats, and liens on your home or other real estate. You are not defenseless, however. You just need to understand how to protect your assets from the IRS tax debt collection process. In a minute, we'll look at the single biggest factor in protecting your assets. But first, let's look at several of the asset protection strategies available to you. First of all, you will know when you are at risk. If you don't follow all of the IRS rules, that's a potential trigger. The IRS will also warn you when they decide to come after you. Your first line of defense is no secret. Just pay your taxes in full, and on time. But, if you could do that, then you wouldn't be in this situation. The next most straightforward approach is to negotiate an installment payment agreement, or an offer in compromise. Setting up an installment agreement allows you to pay your tax debt over a period of time, which can make it easier to manage your payments, and avoid default. It will also help you avoid asset seizures and wage garnishments by showing the IRS that you are making a good faith effort to pay off your tax debt. The IRS offers several different types of installment agreements, depending on how much you owe. If it's impossible for you to pay off the debt completely over 6 years, the IRS may forgive part of your debt and set up a payment plan for the rest of it. Alternatively, you may be able to protect your assets from IRS tax debt collection by negotiating an offer in compromise. If you can show the IRS that you can't pay the full amount of your debt, they may agree to settle for a smaller amount. Filing for bankruptcy may or may not stop the IRS from taking your assets. Even if it works, bankruptcy can have serious long-term consequences to your credit score, your ability to get a loan or a mortgage, and possibly even your employability. A homestead exemption, in states that allow it, may let you protect your primary residence from seizure by the IRS. Creating a trust can protect your assets from being taken by the IRS. However, the trust has to be created before you ring up your tax debt. Your trust also needs to be created for above-board estate planning purposes. What if you disagree with the amount the IRS says you owe? If you think the IRS made a mistake in assessing your tax debt, you can challenge the debt through the IRS appeals process. The IRS appeals process allows taxpayers to dispute the amount of tax owed, and provide evidence to support their case. If the appeals process is successful, the amount of tax owed may be reduced or eliminated. This may also eliminate any reason for the IRS to take your assets. You may also protect some of your assets by convincing the IRS that they're not worth taking. For example, you may be able to show that it will cost the IRS more to sell your asset than what they would get for it. If you need an asset in order to work and earn money, you may be able to get the IRS to give it an exemption, so they won't take it. An example of the most common IRS exemption is a vehicle you need for your work. The next two strategies may also work to protect against the IRS taking your assets, but they are also riskier. These riskier strategies are 1. Transferring ownership of your assets, or 2. Not letting the IRS know about assets. Because of the risk of these strategies, it's even more important to first consult with a tax expert or tax attorney. The IRS can't take what you don't own. Right? Transferring ownership may prevent the IRS from taking assets, but timing is everything. You will need to do it before the IRS notifies you of their intent to levy. It isn't legal to transfer assets if your intention is to avoid paying taxes or to prevent the IRS from seizing assets to satisfy tax debts. If you transfer ownership of assets, and it looks like you're trying to hide them from the IRS, your actions could be considered fraudulent. You could face serious penalties, including fines, interest, and even criminal prosecution. What about not telling the IRS about some of your assets? Strictly speaking, if the IRS doesn't ask, you aren't required to tell the IRS about all of your assets, and where they are. They can't take what they don't know about. But, don't forget, it's against the law to lie to the IRS about your assets. Even if the IRS doesn't directly ask you about particular assets, they will be actively searching for them, using DMV records, real property title searches, state corporate filings, credit bureau services, their own national asset locator tool, and a variety of public databases. How do you know which strategy will work best for you to protect your assets from the IRS? As promised, the single biggest factor in protecting your assets from the IRS is getting advice from a tax expert. A tax expert can help you decide which strategy will work best for you. But, there are no guarantees. Having the IRS take your assets is a serious risk. Working with a tax professional will give you the best chance of protecting your assets from the IRS, even if you have a large tax debt.
To get help with your IRS tax problems and tax questions, please talk to a qualified tax expert. You can work with a CPA, or other tax professional, where you live. Or, if you'd like to get answers to your questions quickly, about your own taxes, you can chat online now with a qualified tax expert. Just click on the link in the comments below this video.